Medical debt used to crush credit scores over tiny bills. A single unpaid hospital charge could drag down approval odds for years, even when the patient did everything right. For years, the credit system treated medical collections like ordinary missed payments. But a broken leg does not mean reckless spending. People do not choose emergency surgery, and they do not schedule a broken arm. Yet the old scoring system grouped all of it together. A consumer might have excellent payment habits, pay their credit cards on time every month, and still get heavily penalized for a surprise bill or a dispute over insurance coding. Credit scores are built to predict repayment behavior. Treating a late medical bill as a sign of financial failure created an algorithm that penalized a user for being sick or injured, rather than accurately predicting their actual financial reliability. To see how pervasive this bad data became, we can look at findings tracked by the Consumer Financial Protection Bureau. This chart illustrates their findings from 2022. Notice the massive block taking up more than half of all third-party collection trade lines. That is medical debt. It completely dwarfs standard credit card debt, luxury spending, and travel combined. Standard hospital bills like this one were dominating the collections landscape. Because millions of reports were carrying the same burden, the scoring algorithms were effectively blinded. The system was so saturated with data tied to health emergencies that it lost its ability to track actual consumer budgeting habits. In the spring of 2023, Equifax, Experian, and TransUnion made a major shift. They adopted a new standard that triggered a sweeping algorithmic update to the reporting environment. Looking at this simulated credit file, you can see exactly how the new policy worked. Paid medical collections were systematically targeted and deleted. Unpaid medical deaths under $500 disappeared right along with them. Small balances do huge damage when a credit file is thin. Every negative mark carries heavy weight. Remove one or two small collections, and the score model can finally breathe, jumping right up into a higher lending tier. Credit scoring models do not reward fairness. They reward cleaner data. A report with fewer medical collections looks much better to a lender, even if they never got richer, paid off other debt, or gained extra income. Millions of consumers saw their scores rise strictly because the reporting environment changed. The algorithm updated, proving the score is just a reflection of the data filter, not the financial reality of the person. The Consumer Financial Protection Bureau tracked the effect of this massive data cleanup in a 2024 report by Zachary Blizzard and Ryan Sandler. This transitioning bar chart shows the exact scale of the reversal. Medical debt plummeted from its 2022 highs, dropping to just 16% of third-party collections by the fourth quarter of 2024. Watch what fills the vacuum in the algorithm. Banking and financial debt surges to 32%, exactly double the medical share, taking over as the largest segment of collections. This filter change directly benefits the consumer. When that medical weight came off, borrowers with heavily suppressed files were suddenly able to cross over into better, lower-risk lending tiers. The composition of collections completely reversed because the rules changed. A cleaner report makes a borrower look less risky, providing access to favorable capital without the consumer changing a single spending habit. Consumer advocate and attorney Chi-Chi Wu highlighted in a 2025 publication that this policy shift started a new story. Consumers must proactively understand what remains reportable in the current data landscape. A credit report is not a full moral score. It is a highly filtered financial snapshot. Change the filter, and the ranking changes. The same consumer can look risky under one system and highly reliable under another. If your score was held down by medical bills, the first step is to pull all three reports: Equifax, Experian, and TransUnion. You need to aggressively hunt down paid medical collections or unpaid balances under $500 that should have been deleted, as they can sometimes appear on one bureau but not another. Be aware of the algorithmic exceptions. Older unpaid medical collections over $500 can still legally appear depending on reporting rules. If a larger unpaid bill sits on your report, it will continue to suppress your approval odds. The debt itself is not forgiven. You may still owe the provider, but its visibility to lenders has changed. You have to audit your file so you know exactly what the algorithm is evaluating. The realistic timeline for taking advantage of this update takes about 3 months. In the first month, pull your reports and identify every medical collection. In the second month, dispute anything that should have been removed using organized paperwork and proof of payment. By the third month, monitor your score movement. You want to ensure the file is completely clean before you apply for a mortgage or an auto loan, because if a lender pulls fresh data while your file is still dirty, you lose the benefit. This is the ultimate financial payoff. A small numerical move can shift you from subprime to near prime. That shift can mean securing better loan terms, lower interest rates, or access to credit cards that were previously out of reach. This entire policy shift simply erased a bad predicted signal from the scoring system. The bureaus finally recognized that medical debt, driven by billing friction and insurance delays, was never a clean measure of risk. If this case shocked you, share this video with someone who needs to hear it. Drop a comment below if medical debt hurt your score, and subscribe to CreditVault to learn the next algorithm truth. Next time on CreditVault, we explore why being an authorized user no longer fixes your credit fast. Until then, remember that taking advantage of this algorithmic shift and cleaning up your data profile is the surest way to save thousands of dollars in interest.